What's up, Bill Club? It's Case Robinson today, and I have a very special guest here on the podcast, Mr. Danny. He is my preferred mortgage lender. I have had quite the experience with mortgage lenders in the past in my short career as an investor, homeowner, and home builder, and I've built a pretty distasteful taste for several mortgage lenders have had experiences with until I met Danny, and he is the real deal. I'm very excited to connect you all with him. We're going to today share information about the mortgage world, tell you about how he can help you not only as a home builder, but also as a real estate investor and also a homeowner. So without further ado, Danny, welcome to the podcast. Tell us a little bit about who you are and your background.
Thanks for having me. Again, Danny Tyrock, met Case, probably a little over a couple years ago, maybe.
Yeah, about 3 years ago, I think. I was thinking on the way here, I think we've done maybe like $1.5-ish million in loans over three deals, which I'm happy to talk about here in a bit, but not the most volume, but we've done a couple, enough for me to know he is the real deal. Probably the only mortgage lender I'll ever work with in the future. So
yeah, and I think just mortgage lending in general, you got to know your products. You got to know those guidelines. You got to be willing to go do the research and really understand what the client or the borrower is looking for, right? And so we were just talking about this off camera, but the first time I talk to somebody, we might have a 30-minute conversation before I even get an application from them. And I think that's what sets me apart in terms of just really diving in and getting those puzzle pieces. And that's kind of what I tell people. I'm like, how do you do a puzzle? Well, you dump all the puzzle pieces out on the table, right? And you start piecing it together and it starts to take shape. Well, some people are going to have 4 pieces. Some people are going to have 40 pieces. Everything from credit, assets, liabilities, income. There's so many different things that we have to look at and so many landmines that we want to avoid. Mm-hmm. And so to do the due diligence up front, that's what I think separates a good lender from a bad lender, and just ultimately really getting into the weeds, so to speak, on what that person is looking for.
What is the process like when someone works for you, works with you? Do they call you? How's that work? Do you say, fill out this application, then we talk? How does that process work?
Yeah, no, I mean, I have a cell phone that is my business phone, right? Again, that's going to be different than a lot of lenders. Like I'm just a dude, right? And my wife is in the business with me also, and I've got a great team behind me. But I understand that my role here is to play secretary some days, and that's taking incoming leads. Because a real estate agent or a Case Robinson or a whole other world out there says, hey, I know a guy, reach out to him. Well, when they give someone a phone number, like, you want to talk to that person. And so I don't have an answering service on the front end or anything like that. Yes, you will fill out an application eventually if you're serious, right? But I want to understand what you're trying to get into, what your timeline is, and what your puzzle pieces are, so that I can provide the best experience possible. Because other lenders, they may take 2 or 3 minutes and then send you the application. I'm going to go a little bit deeper than that, from the very beginning. And that's really where I set myself apart. But just there's so many things that are pertinent to you that may be completely different than what we're used to seeing, right? So that's really valuable to have that experience too.
And not only is Danny just a great guy overall, but he's someone that I get along with in life. And to be honest, I don't get along with that too many people. So I think that says a little bit, but he's someone that I highly recommend, not only as a person, as a friend, and then someone to work with in the mortgage world. And I think that's really something that stands out in his service and the way he operates, because as I mentioned, I've had some nightmare experiences as a very young person trying to buy a house. I've had a deal where I've talked to several different mortgage lenders in the past, and they all seem to promise the world, apply. They want you to apply immediately. Let me pull your credit. And maybe I get it to a certain extent, but Danny is truly the 1% where he sticks out. He gives you the full evaluation on the front end, sets the expectations from the beginning, and he will really earn your trust from the beginning if you're serious about getting mortgage loan of some whatever kind of mortgage loan you're looking for. So I've had terrible experiences. One where it seems like everybody promises the world. They tell you to apply. They promise the world. They drag you through. Once you go under contract, you have 30 days to close.
Mm-hmm.
It's critical time that you can't waste. And I've personally had a deal where I believe it was actually my very first purchase ever, where we got all the way 10 days to closing. This guy promised the world, just drug us along. 10 days before closing, it fell through for whatever reason. This was 3 or 4 years ago, so I can't really remember. And then there I was in a pickle. And luckily, I was able to get out of it. There was another lender who came in and saved the day in 10 days. But I've done several deals with you, and I've experienced that firsthand. Danny, on every single deal, not even that I'm a new client now, on every single deal, we have an extensive conversation about all the details prior to even starting the application process, which is something very different.
Yeah, and I mean, we can just talk about self-employed people to start with, right? Like this is the crux of probably some of the headaches you ran into.
Mm-hmm.
A lot of the people probably listening to this are also in the self-employed world.
Yeah.
So what's important to know, and I'll give you guys a little bit of background here, but my dad's a CPA. And so, I've, for the almost 10 years now that I've been in mortgage, I've had a speed dial, ready to go to help me understand why someone files taxes the way they do. So I wanted nothing to do with accounting. I went to Texas A&M, but I wanted nothing. I'm a marketing major, right? At the end of the day, I'm a sales guy.
Mm-hmm.
And that's really what I do, but I'm not selling anything. I'm just providing an experience. And so ultimately that's not a tangible thing. So content that you provide, information that you can give, that is the tangible thing that someone's going to walk away from a conversation with me. Before getting into mortgage, I spent 10 years in the luxury car business, worked for Sewell Automotive here in Texas. And if anyone knows anything about Sewell, you walk in and it's a different experience. Like you're going to smell those cookies, baking. You're going to get fresh coffee. You're going to get car washes for life. You're going to have a loaner car ready to go. And so all I did was I rolled that mentality into mortgage and how to define that experience and what does that look like in the mortgage space.
Mm-hmm.
And that wasn't like I didn't wake up one morning and say, I have the perfect, and I still don't have the perfect process, but it takes just having a deep conversation. And so going back to why most mortgage situations fail, or someone has a bad experience, and it really comes down to the loan officer probably not understanding how to deal with self-employed people. And so in a matter of 5 minutes, if somebody has their tax returns ready to go, I can look at their tax returns, understand how they file taxes, why they do it the certain way. Are they 1099? Do they file Schedule C? Do you have an S Corp? Like all these different pieces. There's 100,000 different ways that you can file your taxes.
Mm-hmm.
I feel like.
Yeah.
And so to have that understanding and that knowledge is a big part of what I can just kind of coach someone through and let you know, I may not have the answers right here on the phone right now, but give me a little bit of time and I can figure it out.
Yeah, I think it definitely shows through the experiences I've had with Danny on how that really sets him apart from every other mortgage lender I've worked with. So the point of bringing Danny on today is to really connect you with someone that you're probably the only mortgage lender you'll ever work with for life once you have one experience with him, because that's certainly how I feel. And I want you to avoid the nightmares that I've encountered, not only on one deal, but on a couple different, and probably 90% it seems like of all the experiences I've had with other mortgage lenders. Just skip all that, avoid all the wasted money, the headaches and the nightmares and loss of sleep and stress that comes along with that. Skip right to the one mortgage lender that you really only need to connect with for all your mortgage needs for life. So now that you probably have a good understanding on what already sets them apart, tell us about just a little bit more about you, like your real background, where you grew up. I know you got a family now, so tell us.
Yep. I'm married. I've got 2-year-old twins, so that's another thing that Case and I have in common, that we take fatherhood very seriously. I've seen it firsthand. When I went to your first closing, and I rolled in with the baby, and now you got 2 babies, right?
Mm-hmm.
That's super cool, and I was blessed to have 2 at the same time, and my wife's a twin, so
That's awesome.
us having twins, you would think that that would kind of like had been on our radar, and it was the farthest thing from, because she was always told that, it skips a generation. Oh, that was bullshit.
I think my Shelby's mom is a twin,
Yeah.
and you said who's a twin on
So
your wife's side?
she's a female, fraternal twin.
Okay, there you
so
go.
she's got a twin brother.
So we're supposed to have twins because my wife's mother's a twin, right?
Yeah. So okay.
Shelby's
so,
not a twin.
Okay. So but if Shelby was a twin and she had a twin brother, or a female like fraternal twin, a female fraternal twin has the ability to or drop more eggs, basically, is what the science is. And I didn't know that.
Gotcha.
So we ended up with twins.
Okay, I got you.
It's a blessing. It's amazing.
Yeah,
but,
that's cool. I want twins.
Yeah, no. I mean, if I could have just said, yeah, please, we wouldn't change it for the world. But married, 2 kids. Kayla and I both spent time in the car business. That's actually where we met. And fast forward a few years, and I just said, like, here, now's the time that I want to be making decisions back then. And I can think about this. And I remember telling myself, if and when, because I was married before, I said, if and when I get remarried and I have kids, I wasn't married yet. And so I was making decisions for myself in whatever future I potentially had when I was still in the car business. And I didn't want to work on Saturdays. I didn't want to have to go to a physical place on Saturdays because I missed my nephew's birthdays. I missed weddings. You miss a lot. And even though, we got some Saturdays off, and which got to be maybe like 1 Saturday a month, but I work all the time now. It's just not 8 to 7 p.m. on a Saturday. You know?
Right.
And so I got a lot of my life back, and from that perspective, and that's a great business to be in. You can make a lot of money, but I have a more well-rounded, idea, freedom, now. And man, it's a blessing. Like, mortgage has changed my life. And so I try to pour the blessings that I have back into the people that I help. Honestly, I don't know if I've ever said it out loud like that before, but that's the truth. And so, I got into mortgage really not for any other reason other than I wanted a different path, and it's done everything and more, than I would have ever hoped for. So
yeah, you seem to be doing a great job. And to speak on that, I mean, I know I may have not said this back to you, or I probably wouldn't ever say it unless in this instance where you just explained it like that. But that first refinance, which I'll talk about here in a second, the first refinance where I just went out and built a house and had no clue what I was doing, didn't even have 2 years of self-employed tax returns, all these things, I was just going blindly. Probably not very intelligent, but it worked. Whenever I secured that cash out refinance, I was in an extreme bind. And if I wouldn't have been able to do that, it would have really screwed me up, probably for life. I mean, it would have been a bad situation. So that, you could say, maybe not changed my life, but it really helped my life. Right? It was a blessing. Yeah. Same on this last one. So you definitely have that impact whenever you.
Yeah, and to I guess learn from case. Learn from case. Have that plan.
Yeah, learn from
well
me.
In advance. You know, and so I mean, I give you props for the way you went about it and just pure grit, honestly. Yeah. That's what I saw from you, which is impressive. But you're an athlete, I'm an athlete, or we like to think that we are still. I'm 40, so I don't know, I guess that ship sailed. But like that's a real thing. It's like, have a plan. Okay, so if you think about sports analogies, because we're sports guys, it's like, Tom Brady didn't show up on Sunday and just win 6 Super Bowls, right? There was such a specific plan, and he stuck to it, from training to the watch a video and everything else that went into that. And so if you approach what you think you want to be doing, and then devise a plan, then incorporate the people along the way that will help you get there, because no one's ever done it by themselves. And I think about that for my own investment, from my own investment purposes, you can go farther with a partner, and so that's where I've always advised my clients, whether you want to build a house, whether you want to do Airbnb, whether you want to do long-term rental, you can always go farther with a partner on a project, or just those partners that are walking alongside you to help you get there. So
Yeah, I mean, I think it's not that I didn't go about it the right way whenever I was getting started. It's just I was relentless and taking extreme risk. But I think moving forward on all my projects and how you should do it, which we'll get into specific building purposes in a second, is you go into it with a plan. Have a conversation with Danny from the very beginning. Said, hey, this is what I'm looking to do. Get him involved from the very beginning. If you're going to be working with him in the end, that way he can review everything, give you the green light, and you can move forward with confidence instead of just going in it blindly saying this could be bad.
Complete certainty is like there's few like terms that I'll say every single day, multiple times a day, and certainty is the number one thing that it's like the number one word in my whole vocabulary, and then you go execute. And I put that up on the wall, just like, you got to put in the work to execute, but if there's no plan, it could be a different story. So
I guess you've sold some cars in your past. I didn't know that about you.
Yeah.
How long have you been in the mortgage space?
So in 2016, I got licensed. So I'm rolling up right on 10 years. And really the first year of mortgage is like, I was flying by the seat of my pants.
Mm-hmm.
Went to a small broker shop, realized that's not the best path because I had no resources. And in mortgage, every single day is a learning opportunity.
Mm-hmm.
I don't have the answers a lot, but that doesn't mean I can't get the answers. And so the network that we have here at Fairway and the people that I surround myself with locally, we're all grinding together. We're competing with each other, but it's a friendly competition. It's a locker room, At the end of the day, like, we're serving our customers, but when I don't have the answer, I've got a bunch of people that I can call, or email, or reach out to, or go read the guidelines myself. And sometimes even reading the guidelines doesn't provide a clear, understanding of what that person's situation is. So,
So you're with Fairway Mortgage. And I just want the viewers to understand, because a lot of people in the very beginning, you don't know what you don't know. So can you explain what Fairway Mortgage is and how Fairway Mortgage is different from a bank, and the kind of mortgages or loan products you specialize in and how that's different from a bank? Because Danny, you don't offer construction loans specifically, which we'll talk about how you can help builders, but what is Fairway Mortgage and what kind of loans do you offer and how is it different from a bank?
Yeah, so if you think about the traditional mortgage, right? If I'm going to go buy a house, most people are thinking conventional loan, FHA loan, VA loan, a USDA loan. Like, those are your typical, like, 4 types of loans. But there's this whole other world, right? And really going back to 2022, when we saw rates really starting to kind of skyrocket, right? And why that happened, I could do a whole podcast on that. But I just had to find a way to say yes to customers, right? To find solutions. And there's this whole non-QM space. Non-QM basically just means it doesn't fit in the typical, box. And so a lot of those loans, most of those loans don't consider tax returns. Okay, so there's very qualified people out there that can't fit in the Fannie Mae or Freddie Mac box because of either the way they file taxes or whatever the case may be. So Fairway Mortgage, we have over 2,000 loan officers across the country. I'm licensed in 5 states, but that's Texas, Louisiana, Colorado, Tennessee, and Florida. Basically, I want to be licensed in, obviously, Louisiana because it touches Texas, but the states that I would be willing to buy an investment property. And that's just my opinion, but I think about vacation rentals a lot. And those are the main states that I've gotten asked to do loans in. And I can get licensed in other states easily. It's a few $100 in a couple hours of training. It's the same process. So I can help people in other states. I just would need to be licensed in that state, and that's not difficult. And so Fairway's the number 2 mortgage lender in the country. Okay. Most people think as a first-time home buyer or just as a home buyer or someone looking to invest in real estate, I need to go to the bank. Stop right there. Like, banks are going to think about buying a house and mortgage differently. It's a different experience. The thing is that the person you're talking to at the bank, they don't have to be licensed. Most people don't know this. The bank is licensed. The credit union is licensed. The person you're talking to is and I'm not saying that this is the end-all be-all facts, but there's a high probability that that person that's at a bank or a credit union does not have the experience, because they're probably a salaried person up front that been doing this for 2 years or 1 year. And we've only been doing it for 1 or 2 years. You just don't have the experience. So mortgage lenders, we can broker stuff and I can underwrite stuff in-house. And so Fairway has taken a big push into the non-QM space. And so we have a lot of these products and different investors in-house that we actually underwrite, which speeds the process up. And so that you might only be 2 days in underwriting, and we can still close those loans quick in 3 weeks or less. Whereas I can broker stuff also, and I have another suite of maybe 16 or 18 investors that I can broker to, and they have a little bit different guidelines on some stuff, and they have a little bit different appetite. And so there's this whole secondary market where, yes, I'm your point of contact, but I could go one of 2 ways, specifically just in the non-QM space. And non-QM is going to be anything like bank statement loans, DSCR loans, which is an investor product, your 1099 loans. I mean, we even have like an asset-based product where you can, if somebody had $1 million in the bank and they wanted to buy a house for $300,000 cash and they didn't have any income, technically, because they have the money, there's a product out there for that. And a lot of people don't know that. So yeah, just leaning into those new, kind of new products. It's just, they're not new. It's just that they're not widely known.
So and maybe this is challenging for you to do. So if it's challenging, just do like the main 10 or 15, whatever you can recall off the top of your head. What are like list them all from non-QM to QM or whatever, Fannie Mae. What are your main loan products that you offer?
Yep.
And like starting with the most popular and then leading into maybe the less popular.
Yeah, I mean, if someone has good credit and they're a W-2 employee of a company, you're probably going to do a conventional loan. So I would say 60 to 70% of all the loans that we're going to do are going to be conventional loans. And now there's some little nuances within the conventional world, but for the most part, they all look at either A, your tax returns if you're self-employed, or it's going to be an easy W-2. I'm a salaried individual. I get a little bit of overtime, or I'm an hourly employee, hourly wage, or I get some bonuses. So that's your traditional. That's what most people are, right? That's what most people are. There's this other side of things that, and if you're a veteran, you're going to do potentially a VA loan. But I just did a loan for someone that was a veteran, and it didn't make sense for them to use their VA loan because there's a VA funding fee involved. And so I showed him, side-by-side comparison with conventional, and he went with a conventional loan. And so each of those scenarios can have its, and again, I go back to the landmines. We want to avoid the landmines and save you money when I can. So conventional, VA, USDA, we don't do a lot of that, but that's basically like if you want to buy a house, they have really tight windows where, yes, you only have to put 0% down, but like you have to have really low DTI and you have to make less than a certain amount of money in that specific area. So it's a very niche thing to do a USDA loan specifically. It's like more like kind of outside the city areas. FHA is also kind of a low down payment, first time home buyer. A little bit more flexible product. So if you're not a 720 plus credit score, then FHA could be a good option. FHA technically goes down to 580 credit score, but we still have to get the automated underwriting approval. And so FHA is another loan product that allows people to just buy houses or actually do renovations on a house.
Mhm.
So within those just main four, you could do a renovation loan in FHA world and also conventional. And I've done both of those also. So those aren't overly difficult. I think I did like 4 renovation loans last year. Hey, I want to buy this house. I want to put 100K into it. Okay, so you buy it for 300, put 100K into it. As long as the comps show that will be worth it, right? We talk about ARV a lot. What is the future value of that house? Well, that's a good way to force appreciation in a house. And so sometimes that's actually a better way to start getting into investing is to do a renovation loan, because you still only have to put 3 or 5% down in those scenarios, and you can roll your renovation in.
Yeah, that's sweet. I never did
So
that.
that's a really good way to get started, honestly. And then, moving on to just other loan products. Yeah, bank statement loans are something that we're going to look at.
So this is a non-QA.
Yeah, so if you switch over to non-QM, they all do the same thing. Like you could do a purchase in this scenario. You could do cash outs in these scenarios. You could just do a rate term refinance in those scenarios. But bank statement loans are going to look at the cash flow of either someone's personal bank account or their business bank account. So let's take the person that operates a business, and let's say they make $200,000 a year. The baseline is a 50% expense ratio allows me to then use $100,000 as their income. That's the basic way to do a bank statement loan. And a lot of people will easily qualify this way, especially if they wrote off everything on their taxes. There's other ways to qualify in a bank statement loan world. You can have a CPA write a expense letter. It says, hey, this is the structure of the business. Expense structure is only 20%. Or he doesn't have any expenses because he doesn't have any inventory, for example. So that's a different scenario. And you can use a CPA to write a letter, and go that route. So bank statement loans are a really good alternative. They're typically going to require a bigger down payment though, right? And so that's the downside of doing a bank statement loan compared to your conventional. But what I show people is I go, look, you saved how much over here because you wrote off everything on your taxes, for example. But you can't do conventional. But you're going to have to come with a bigger down payment, and the rate's going to be slightly higher, and that's just what it is. Yeah. That's why they're the non-QM space. There's going to be some trade-offs, but still accomplish the goal. So bank statement loans, DSCR loans are investor-only product. That is not looking at someone's income; it's looking at the property. So the best way to think about this is it's a commercial loan in the residential real estate world. So, okay, I'm buying this house and it's a short-term rental or a long-term rental. So there's going to be a projected rent, future what I'm going to earn on this property. So an appraiser goes out and he's going to tell you the value of the house, and he's going to tell you what the rent is going to be, right? Based on comps. Okay, the same house, 3 doors down, around the corner, rents for $2,000 a month. Okay, so now my rent is $2,000 projected. Well, I'm buying the house. I obviously don't have a lease on that house yet. So as long as the payment is less than $2,000, you have a DSCR ratio of at least 1 at that point. So that's the goal: is the rent going to cover my payment? That's the basic idea of DSCR, and those are going to be a 20% down, always type of product. But with DSCR, again, that opens doors for people that, as long as you have good credit, you can use this product, but it is more of a long-term hold product because it will have a prepayment penalty. So you get better rates, but it's going to be at least a 1-year prepayment penalty. So this isn't a flipping product. And then, still in the non-QM space, like a 1099 program, for example, let's say someone's been in the same line of work for a couple years, but they are 1099. 1099 is considered a contractor. So with that, they may write off 50% of what they earn on their taxes, right? And they may not fit in the conventional box, but I can just use a 1-year 1099. So let's say someone made $100,000. I can use that 100 grand 1099 only and take just a 10% expense ratio. And now I have $90,000 of income. So again, these are niche products that most loan officers either don't really dabble in, but I just look for solutions.
Yeah.
And then when those scenarios come up, it's like, all right, like we can hit the ground running. So
Okay, so if you could say very plainly, a mortgage lender is a lender that, maybe I'll try to do it and you can correct me. A mortgage lender is a lender that lends loans for permanent mortgage to either buy or refinance a house, right?
yeah,
That's what you specialize in. You don't do
Yeah.
lines of credit.
Right.
You don't do business credit cards. You don't
right,
do.
right. Yeah, I'm not a bank.
Yeah, you're not a
Right.
bank. That's
And
where
that
you're
is the
really
difference,
different. Yeah,
right? When
you're
you
really
go into
different.
a bank and you want to do a mortgage thing, well, they may have a mortgage guy there, but they're also wanting to get credit cards,
The
and checking
deposits.
accounts, and all the stuff, right?
Yeah.
The CDs. I mean, I don't do any of that stuff.
Mhm.
Now we do some HELOC stuff, but if I don't have the product that's the best fit, I have those relationships, and we were kind of talking about that before. Is I have some local folks that if I don't have the right product, and that doesn't mean that I'm not very familiar with it. Even when you started your most recent project, we talked about kind of the overall process, and you went that route, not even with someone that I had really been working with, but I generally knew the process, and I was like, yes, go, yeah, do that. And then if you need, after the project is done, then I can get involved, you know? And so it's a similar thing that we did for you that, you know, the person looking to build can also be in contact with me and be involved, in, you know, at the end too.
So if you're looking to either buy a house or refinance a house, you're the guy, right?
Correct.
Okay.
Correct.
God, I just want them to understand. I think a lot of people there's some people in our community and members and students of mine that are 20 years old, 21 years old. They've had success in like e-commerce or something, you know, that our generation is doing now.
Sure.
And they've came up on a lot of money and they're like starting to build houses, but they're completely new to the world. They don't understand the difference between a bank and a mortgage lender, what a mortgage lender is. So if you're looking to buy a house or refinance a house, Danny is your guy.
Yep.
If you're looking for other kind of bank services, line of credit, business credit cards, checking account, that's with a bank. So
Right.
hopefully that helps you understand what a mortgage lender is and what Danny is. So now I kind of want to get into the specifics of the 3 ways that people go to build a house. 3 ways. They go to build a house to sell, build a house to rent, or build a house to live in. That's the 3 ways, 3 strategies you go into a build project with. Well, obviously, if you're going to be building a house to sell, well, then the exit strategy there is once it's finished, sell it, and then wipe your hands clean, collect your profit. Danny's really not going to play a part in that process. Now, if you want to just have a conversation with him about maybe people he knows in the construction loan world or whatever, just want to introduce yourself to him, sure, you could. Maybe he can connect you with others that I don't know if you just want to have that kind of conversation. But if you're building a house to sell, Danny's probably not going to help that much directly. Now, in the other 2 options, build to rent or build to live in, he can help you. And to start, I think the most valuable way is the build to rent process, because it's a very popular way that people get into building, or that people are building here in the community. They're building houses to rent. They like to be able to have a brand new asset. They like to go through the building process and build in that equity. They like to control the quality of the construction and their asset and the quality of finishes, put in durable finishes that last forever. And then in the end, have a new construction product that you're not buying a 20-year-old house that the AC is about to go out or the roof needs to be replaced soon. You're getting a brand new asset that's cash flowing from the beginning, equity built in. So a lot of people in the community, and I've done it myself, build a house to rent, either with cash or your creative financing, credit cards, or get a construction loan to build to rent. And then once it's finished, do a cash out refinance, which is what I did on my first 2. And I worked with Danny specifically on those. And whenever you're building a house to rent, Danny is someone that, like we said in the beginning, you should have a plan from the beginning, have a conversation with Danny, go over your plan. Hey, I want to build this house to rent. Have a 30-minute conversation with Danny like he said he would. Introduce yourself. Let him go through all of his kind of pre-qualification questions. That way y'all go on the exact same page. and he can give you the certainty that you want to hear, knowing that whenever your project is finished, y'all can run the numbers together. He could then do the cash out refinance. I did it on my first two. I can't remember the exact loan type we did, but essentially I built my very first house and my second house the exact same way. I built it with my own personal cash and 0% interest credit cards. So I leveraged 0% interest business credit. I want to say the first deal was like a $227,000 cost deal. I put in like $120,000 of my own cash that I had in the bank account, and then I leveraged roughly $100 and something thousand in 0% business credit. So once it was finished, I was in deep credit card debt. I invested a lot of my own money. I called Danny, and we got the process started to obtain a cash out refinance so I could recoup all that money, pay off my business credit, recoup my original investment. And I think that would be a great way for people to connect with you. I think that's a great strategy because it allows you to pull out all that equity. And on those deals, actually my first one, I was able to pull out, I think it was 75%. And it allowed me to obtain my first rental property for literally $0 out of pocket because it cost me $227,000. It appraised for $305,000. I got a 75% cash out, which came out to like $225,000. So I gained that property 0%. Cost me $0. The next one, I think I even made money on acquiring the rental property. So a very strategic way to get into home building, and you could definitely help them on the cash out refinance side on the back end.
And that's a lot of what I am doing now. And again, we talk about how someone's going to qualify, right? Like, what are their taxes? Like, what does their income look like? Because some people may have that real job and they can qualify in the conventional world, and we may do a conventional cash out, or they may fall into this other category for non-QM making more sense. So we do a cash out DSCR loan, for example, right? And so if you built this house to rent, and it's currently maybe even not rented yet, right? Like you just finished the house. As long as you've owned the land for 6 months, which you probably had at that point when the house is completed, I can do a DSCR cash out at the 6 month and 1 day mark. I'm about to start one today for a client, and take 75% of the new market value, right? So you look at the land, what'd you pay for the land? What was your building cost? That's all great and fine, but what I'm looking at is the market value, right? What is the market value of this house? And so, but that really needs to be a conversation that we have 6 months prior before you even buy the lot, right? If you buy the lot for 100 and it costs you 300 to build, you're in it for 400. Well, I hope it appraises for at least 500 at that point, right? Because I can still only give you 75% cash out, any lender, on an investment property specifically, as long as, again, that's going to be a long-term rental. But yeah, that allows you to kind of keep that cash moving to where you can go do the next project.
Yeah, like recycle your capital, pull it all out and just rinse and repeat over and over as many times as you want.
I love when people tell me that they pay off a mortgage, by the way. I'm like, why did you do that?
Oh yeah,
that's
so
ridiculous.
Stupid. Well, that's people following Dave Ramsey.
It's so stupid, dude. So stupid. Don't do that. Don't pay off your mortgage.
Is he not a joke? He's running the internet on that stuff
and
too.
Know,
a lot of people
mortgage
follow
company.
Him. Does he really?
Yep.
I didn't know that.
He'll tell you to pay off the mortgage, but he owns a mortgage company.
What? That is insane.
Yeah. Talks it on both sides of his mouth.
Hopefully, y'all aren't listening to Dave Ramsey.
Dave Ramsey will help you get out of debt. Okay, yes. He'll help you pay off your credit cards. Don't listen to him about mortgage and buying a house and the good kinds of debt, which is allowing you to maintain your cash flow. Dave Ramsey doesn't know the first thing about cash flow. Let's be honest, because he's rich. You know, that's my soapbox.
Yeah, I don't listen to him too often because the first time I hear him talk, I scroll. But I'm sure if I listen to him,
he's got a few little hits out there that do make sense. But for the most part, man, just there's different ways.
Yeah, there's good debt and bad debt. Obviously, use good debt.
Be able to keep that money moving, and so otherwise, you're gonna have like 2 properties in 5 years.
Yeah,
you know,
exactly.
I've helped people get like 10 houses in 5. You know, 2 a year sometimes, easily.
So if you're building to rent in the end, and you are someone that has a W-2 job or a salary, and you're building a house, rent it out, or you don't rent it out, but you build it to rent, it's finished, Danny can get you a conventional loan of some sort. where you're kind of more easy to qualify. You can go with the QM kind of loans that are a little more easy, it seems like. And he has a product for you that's going to be easy. He can get you 75% loan to value, right? In comparison, if you're someone that's self-employed, or maybe you're someone that's really whatever, you got a little more challenging situation, not the best tax returns, not the best income situation, but you build this house to rent. In the end, he can still help you with a non-QM loan. Same, he can get you a 75% cash out with another more creative loan product like a bank statement loan or a DSCR.
Exactly. Yep.
Okay, and I want
to accomplish the same goal.
Accomplish the same goal, regardless of if you got 5 years of tax returns, a bunch of income on your taxes, or if you really don't. If you build that house and the numbers make sense, the house is worth that amount.
That is the
numbers make sense.
That is the income producing thing at that point.
Then you can lend
in the DSCR route.
Yeah, and that's how I did on my first two. I can't recall. Maybe you can. Do you know the kind of loan product we use on my first two or no? If you don't, it don't matter.
I think we actually were able to do a conventional loan.
Were we?
Yeah.
Based off my income. Okay.
Yep. But we had strategized around, because that process took a while, and so I think that you were in the process of like about to file your taxes, and so we were talking about how you should file your taxes.
Yeah.
And I was like, okay, make sure that you show enough income here, and in this way, because that's how I can use it.
Yeah.
And CPAs, by the way, they don't know mortgages.
Yeah.
So here's a big drawback, and I feel like this should be a hot take, by the way. Don't listen to your CPA about what you can afford in the mortgage world. They don't understand mortgage, right?
Yeah.
They're trying to help you save taxes and get all your write-offs and structure your taxes a certain way, okay? A CPA does not understand how these things flow through and what an underwriter is going to require and what the Fannie Mae guidelines are. You need to have this and a mortgage lender, and in a perfect world, this CPA and mortgage lender communicate, and they're understanding, and they help each other.
Yeah.
And so, one of the biggest things I have to deal with is actually, hey, can I call your CPA and talk through this? Because you're about to file the taxes. Send me the draft of your taxes before you file them. That is something I do. Most lenders don't do that. They don't know the first
So
thing.
a CPA will bite you in the butt trying to save you an extra $10,000 in tax payments.
Yes.
Disqualifying you from being able to purchase that future investment property, or being able to build that house or obtain that cash out refinance, all in an effort to save you $10,000 in taxes, which I get it.
Right.
But you got to find that middle ground, because maybe saving $10,000 in tax payments to the IRS, disqualifying you from obtaining a $400,000 cash out refinance is not what you would want to do.
Yeah, CPAs, generally speaking, and I'm sorry if anyone's a CPA listening to this, but CPAs are not salespeople, right? Their brains aren't wired like yours and mine are. Yeah. So they don't ask the probing questions in terms of, if we do this a certain way, what are the repercussions? Because those tax returns are going to stay with you for 2 years, right? In terms of the mortgage world. And so a CPA is not programmed. Again, it's just a left brain, right brain type of thing. Whereas I'm going to be asking questions thinking about now and into the future, whereas a CPA is looking like in the past, straight up. That's what they're doing. They're looking at, what income did you have? Well, right, so this is 2025, and we're not quite to the tax day yet, but if you think about it, just doing your taxes, I got to go back and think about something I did last year. Like that alone, I'm like, well, that's what a CPA does. They're always looking backwards. Whereas a mortgage lender, I have to look forward. Like, you're going to build this house, you're going to buy the land, so we're going to get a plan, and then 12 months from now, we're going to cash out, and then you're going to go do it again.
Yeah.
So it's a different thought process.
Yeah, that's extremely good advice. It's kind of difficult because it's a difficult thing. You're dealing with a CPA, which has this different, brain functioning way of thinking. Then you're dealing with a mortgage lender who thinks a different way. And you're probably dealing with an attorney who, so it's all three things that really need to work coherently, symmetrically, all working together, but they're all three different services working separately. So it's great advice, and he makes a great point. And I've done it in a couple instances where, like I did on my first one, where Danny mentioned he was involved helping give, not advice necessarily, but saying, hey, your tax returns need to show this for you to be able to get the cash out refinance. But his advice in that you really need to loop in the CPA, the mortgage lender, and possibly even attorney in certain situations, all to make sure they're on the same.
Yeah, open lines of communication between those people that you're involved with.
And sometimes
so you don't step on the freaking landmine. Like that's the whole thing. So.
Yeah, that's great advice. Sometimes it's not really needed, like when you're just going to buy a home necessarily. I mean, maybe it is, but it's just great advice to be aware of.
Well, so to that point, how long in advance? I'm gonna ask the question and I'm gonna answer the question, I think here. But how long in advance should you be talking to a lender, right?
Yep.
There's not a set in stone rule there. You know, it depends on what you want to accomplish. If you're thinking, I want to build a house in 2 years. We'll go ahead and have a conversation with the lender today.
Mm-hmm.
And then, you know, you can start game planning things. It's like planting seeds, right? Then like the tree, right? You water it and it grows. And I think that you and I both are similar in that way. It's like we consume content or things different way to think about what the future looks like. Mm-hmm. And so if you just said, Google, blah, blah, blah. Well, how they might say like 3 months. Well, that's not really the case. Someone may have a little credit challenge here or there. More often than not, there's something on your credit report that you don't know about. And so if there's that one little collection that you need to get removed, that might take 2 or 3 weeks. So if you've only contacted me the day that you're ready to buy a house, that you just walked into an open house and you've got this little credit challenge, that's an easy fix, but it takes 3 weeks, right? Like we're really cramped for time now. Mm. So 6 months out, you know, like might as well. Yeah. Hey, my lease is up in 6 months. Okay, start there.
Yeah.
6 months would be a really good like baseline if you're just wanting to buy a house. Just, hey, I want to buy a house to live in it. 6 months. Mm-hmm. And then you may not even do an application for a couple months down the road, but at least you've got the wheels in motion.
Yeah. So. Yeah, and I don't think you'd have any problem with people reaching out to you just to make an introduction, saying, "Hey, I saw you on the Build Club podcast. Really like you. Here's my plans for the future, whether it be 6 months, a year down the road."
For sure.
Just to get on the same page, introduce.
For sure. And everyone's situation is different.
Yeah.
You know, there's no one pre-approval that's the same.
Yeah, and likely, especially if you're a beginner, you're gonna learn information on that call. You're not just gonna meet Danny and say, "Hi, my name's this." But you're going to learn information just by telling them what you're trying to do, that you're going to learn from that call, take information from that call that can help you on your project. So I recommend everyone to do that.
Yep.
So on my first couple projects, he said, I got a conventional type of financing, conventional cash out refinance on those rental properties. So he can definitely help you in that regard, whether it's conventional or the non-QM. But on my most recent build, and that was build to rent, on my most recent one was a build to occupy, primary residence. And this is a little more challenging situation, building your own home, which Danny has a way that he can help you out if you're located in Texas, which I'm excited to hear him explain that in depth. But I just want to talk about building to live in, because there's a percentage of people that go out and they want to build their dream house, or maybe they just want to build their one home and be done and live in it forever and, you know, never build again. Some people do that. Getting towards their older age retirement and they're ready to set off into the sunset. So building your own house, to my knowledge, let me make sure I say it right. I'm only aware of 3 real ways, and I believe Danny's going to educate us on a new one. I'm only aware of 3 real ways you can build your own house to live in. The first one is using your own cash and creative financing or whatever, using your own resources. That's the obvious one, which I think some people have to resort to because of the lack of financing in place available to build your own house to live in. And I went through the process myself, building a house to live in. I was trying to find lenders to lend me the money to do it. Even though I already had 2 builds under my belt and a successful track record, no one wanted to lend me. Every single lender I called, whether it be banks, loan officers within the bank, mortgage lender, I was just calling people to see if I could reach a connection. Probably talked to 50 people. Everybody got me the same answer. No. I would say, okay, why? And they would say, it's too risky. We can't lend the consumer, the borrower, the money to build their own house. It's too risky. What happens if something happens to you during the project? All these different things say it's too risky, not happening. So I found that out. And given that I didn't have $1 million in the bank to build the house, well, I couldn't use cash. So I resorted to something that is popular term and a popular loan product to be able to do it called an owner builder loan. But what I found is that nobody offers an owner builder loan. And if I came across a lender that did offer an owner builder loan, it was extremely stringent approval process. It was just very difficult to get approved for. And honestly, as I can
Would
recall,
you do it again?
absolutely. If I can recall, there was only 2 lenders that I even found offered the owner builder loan. One of them didn't even offer it in Texas. He was like out of state. I found him like a YouTube video or something. And I think it was called like Cherry Creek something. But they're not even in Texas. The other one was Prosperity Bank in Texas. And it was just the right fit, the exact right fit. And it all worked. So that's how I financed my own. But that was an owner builder loan. In order to get approved, you had to meet the consumer qualifications. You had to have good credit. You had to have the income to qualify for the end mortgage.
And that's where the banks are going to be, looking at the traditional, products, right? Any construction loan. Let me just say this. I think this is my, not an opinion, maybe not a complete fact, but most banks, and I don't know if there's one out there that doesn't look at it this way, but they're going to look at the traditional financing ways for construction loans. Like, what are the tax returns? Or your W-2?
Yeah, that's the
It is
process I
a
went
debt
through.
to income ratio.
Yep.
And most of them are going to have like a 43% rule. So that means, if you make 10 grand a month, okay, $4,300 is your all-in final, all of your debts on a monthly payment basis. And so debt to income is on a monthly payment basis. So, think about if you have a car payment, if you have other rental properties, whatever else, it has to fit into that 43% box plus the new payment, So yeah, it can be pretty, tight to qualify on those.
Yeah.
So,
and I think a lot of people just aren't going to be able to check all the boxes because it's so difficult to check all the boxes that are required to meet that loan. The experience needed to build a house and become a qualified builder for the loan, and then the income qualifications and the debt to income. It's a difficult product to get approved for. The bank I went through is Prosperity Bank. It was a very stringent process on getting it approved, but luckily it all happened. It all worked out. So that's the other way to finance it is an owner builder loan. It's a great way to do it, but it's just hard to find a lender to do it, and it's rather hard to get approved for it. And then the last way, which is honestly, it's it's not a frowned upon thing. I think it's really bending the rules, which is called getting a builder of record, which involves you hiring a builder or partnering with a builder to essentially have him be the builder of record for your project. So just say Danny wants to go build his house, but he's never built a house before, and he could get a regular construction loan from a bank or a construction lender and then have me be the builder of record because I have built houses. I'm now a home builder. I could go sign the papers with the bank, and maybe I charge Danny an expensive fee, 50 grand, depending on the size of the project.
Right.
Charge him something because I'm putting my liability on the line by being that builder of record. I'm responsible for the outcome. And that's the only other way I have come across people being able to jump this hurdle of building your own house and obtain financing is maybe getting a builder of record, which is really bending the rules. And I think it's really frowned upon in certain instances by certain banks, but that's the only other way.
Yeah, because there's a whole
ways.
draw administration process and stuff. And the banks are also going to require the builder approval process too. So like that means the builder has to have $1 million of liability insurance. We've come across renovation loans just last year where, in Texas, we don't have to have there's not a contractor license, right? And so that's something that in other states they may have, but in Texas, you're going to get some fly-by-night contractors, right? So there's a contractor or builder approval process that the lender or the bank in this case, or the construction loan is going to require. So
kind of circling back to the build to occupy, build your primary residence, I want to talk about how I really did it, the entire process on how I did it, and maybe you can learn from that. And then I would like for Danny to kind of explain to us, if you're in Texas, how he can help you build your own primary residence now. And I think it's a little relevant to how I did it. So I obtained my owner builder loan from Prosperity. It was a construction to permanent loan. So it converted from, once the construction was finished, they financed the entire construction loan. I put like 10% down, and then it automatically converted to a permanent mortgage. So I was able to have that permanent mortgage for 25 years. Although at that point, I'd went like $300,000 over budget. My budget was like 650 in the beginning. It ended up being like 950. So I had put so much money into the project, which forced it to appreciate and made it worth more than what I originally intended on it being worth. And I had so much equity in the deal. I had so much of my money in that property that I got with Danny, and we did another cash out refinance where the appraisal came out. They appraised it. I think it appraised for 1.13 or something, 1.15. After I got that appraisal, then Danny was able to give me a 80%, not 75%. 75%
Because it's
is
your primary. Yep.
okay. So 75% is for investments, but 80% can be your cash out if it's for your primary. So I obtained an 80% cash out, which essentially paid me like $950,000. I was able to recoup all my money, recycle my capital, and now I'm getting ready to take on my next project. So that's how you help me.
You had a loan for total at what? And the amount, the cash out loan was like 900 something, right? And then you had basically, because that financed the lot and the construction, but then obviously separate from your cash, what was the loan that paid off at that point? It was like 600 something maybe?
No, it was less than that. I want to say it was
500?
like 550.
Okay.
I mean, something like that.
So obviously you had your own money that you were kind of paying yourself back and all the credit cards or whatever else, or just cash. But yeah, that is one way to go, right? But it's still gonna be the kind of the 6 months required, and then depending on the loan, could be looking at 12. So yeah, definitely want to make sure we understand, and we avoid the landmines.
Yeah, and I think on my loan, I'm pretty sure on that one we did a bank statement loan, which is a non-QM.
It's also non-QM.
Non-QM. Yeah. So for that specific one, I had to own the land for 6 months. So if you do any kind of cash out, you have to own the land for 6 months before you can do the cash out.
That's what they call a seasoning period, by the way.
Okay, so it has to be 6 months season.
Yep.
And did a bank statement loan and was able to recoup it all. I mean, it all worked out, but
yeah, and not everyone's going to have the ability to do a bank statement loan, because if you don't have like this stream of income coming in, you're not going to be able to really go that route. And so you've been successful in another field, which is my perspective has allowed, and it really catapulted you like SpaceX style into this space because of that grind that you did for at least 2-3 years prior, 3 years before you really diving in full head of steam here.
So those are the 3 ways that I'm aware of really being able to build your own primary residence. It's something that's it's a hurdle that keeps a lot of people from being able to do it, is getting the financing. But you can either build it with cash, you can build it with an owner builder loan if you can find a bank to do it and actually qualify for it. And then lastly, the builder of record, which is really bending the rules. You're probably not going to find a builder to do it. But what other ways can you help someone in Texas?
Yeah, and so so let's talk about builder of record there for a second. And there's also builders out there. There's some here in Montgomery County. A friend of mine's building a house as we speak in Magnolia, actually. And it's not necessarily builder of record that he's doing. It's just he agreed to a flat fee with the builder, and like that builder is doing everything. And it's a custom job, but it's not builder of record. He still obtained his own construction loan, okay? And there's still a draw process involved, but he just agreed to a X plus X, right? So whatever cost plus 20% or whatever that person's agreement was with him. And I don't know that answer, but that is kind of one way where it's just more transparent, I think. I think me personally, and maybe most people listening to this, is the hidden cost when you go, okay, I want to do any job or build any house or do anything. It's like, okay, well, here's like your summary, and there's like 3 main categories, and then they just lumping everything together. And you don't know what the actual breakdown is. Like, I'm the kind of guy, I want to see the line item, itemized. What are we doing here? And how can we save some money here? I might spend more money here, but I'm going to save it where I can. And so, that might be a route for somebody too, is just to get with someone that's, has a good kind of portfolio that they know, like, and trust. That's a big thing for me. Do you know, like, and trust this person or this builder, or you're going to have to work with them, Same thing with a real estate agent, same thing with your insurance agent, same thing with your CPA, your mortgage lender. That's just the way that I go about it. And it's done, good things for me. But, that flat fee might be an option for somebody.
Mm-hmm.
So
most of
and they still come out ahead with
Yeah.
with equity
Mhm.
is what I see a lot of times. It is a longer process, of course. It's not like going down to D.R. Horton and getting a house that's ready to go.
Mhm.
It's a different thing. You're not going to walk away with a bunch of equity in that sense. And so I think that may be something good for people to know too. Is like buying a new construction house, that builder is making all the profit. You will not walk away with a built-in amount of equity.
Yeah, zero.
You have to have that sweat equity. This is the entire build club, right?
Yeah.
The whole point is the sweat equity aspect of this, but you can still get 75% of what sweat equity you would have had by not completely doing it on your own.
Mm-hmm.
And there's a lot of risk to that. And you may or may not have the means to do that. So construction loan, working with someone, partnering with someone in some fashion. Again, we could get into some different strategies on that.
Mhm.
If somebody wanted to. So
Yeah, but definitely the cash out refinance on the primary residence side.
yeah,
He can take care of you on that.
for sure.
Okay, well, you kind of touched on this in the beginning, and I kind of want to circle back to it because there's a lot of people that come into the community. They've never even spoke to me before. They just see my content. They come in and they're like, I don't even know where to start. Well, one big qualification that you need is financing. And in order to get financing for either a build to sell or build to rent, to get a construction loan from a lender is experience.
Mm-hmm.
And you're not going to be able to get experience without getting financing. So one thing that banks will consider, construction lenders will consider, is rehabs and renovations.
Mm-hmm.
So either if you're a contractor or if you're not a contractor, saying you've renovated a couple homes or flipped a couple homes is something that they will use to qualify you for your first project. And I actually did that I flipped one house before I ever built a home, and I didn't know of this kind of loan product.
Mm-hmm.
So if you're someone that is brand new and you're just like, I don't even know where to start, maybe you're not in the best position to go out and build your own house with your own financial resources or creative financing. I think one very creative way that I've just learned about kind of today, which I wanted to ask about, do you offer rehab and renovations loans? Can you walk through exactly what that could look like and
absolutely.
the strategy behind that?
So to that point, I think I would add the hardest thing for people getting started in real estate, period, is the down payment. Okay, so this is probably the most common thing that I tell people is that the hardest thing to save for is the down payment for the next house or this house, and it might take them 6 months, right? So especially when you're getting started, you could put 3 or 3.5% down buying a house.
Which on a $300,000 house is a
$10,000 roughly, right? So you have closing costs on top of that. Let's call it $15,000, $16,000. Okay, so if you have $15,000 or $16,000 saved up, you can go buy your first house, roughly. Okay, now again, everywhere is going to be slightly different, but that's a really good rule of thumb there. So within both conventional and FHA, you can do a renovation project. There's big renovation projects and there's small renovation projects, right? So there's a couple different ways that we look at it based on what the cost is and what you're doing to the house. For example, I had a young man come to me that was buying his first house, and that this is a little bit more expensive house, but the house was fine, but he had like a garage apartment in the back that was completely dilapidated. Okay, so it wasn't going to pass like the basic appraisal rules in terms of the condition of the property, because that was what's considered an ADU, accessory dwelling unit, but it had 3 doors. Okay, it had 3 living units. That didn't fit in the Fannie Mae box, and it was just like it needed to be completely tore down or ripped to the guts, basically. And so the condition of what it is currently doesn't matter if you want to do a renovation loan. What matters is what it's going to be. Okay, so you need to be prepared in this scenario too. You're going to have a hard time if you've never done one of these to close it in 30 days. So this young man came to me with like his plans and everything ready to go. He had his contractor, and we did get that one done in like 24 days because it was a rescue from another lender that couldn't do it or wasn't willing to. And so I told him up front, because I've also done kind of a full renovation deal before, which can be painful, but it also can be profitable in the end, but it will suck the life out of you if you're not really prepared for it. So in the end, what it was going to be, just specifically in this case, what the accessory dwelling unit, the garage apartment, what it was going to be was a single door, a single unit, which fits in the Fannie Mae box, and completely repainted and all new structure. Like, you know, I mean, the thing was kind of like not even safe, right? And that's where the appraiser is like, hey, this is going to be a subject to appraisal. And what that means is like, I can't close a loan because it's subject to just making it safe. That's what that means. So most appraisals would be as is, meaning, hey, this is good as it is. So that doing a renovation loan is a great way to get started in real estate because it's a low down payment scenario, potentially. And you can roll those costs in as long as the market supports it. Which I just learned today that the owner-builder situation would look at a renovation loan or renovation that you've done as a project, which is great. Actually, I'm learning something new today. I did not know that. So.
Yeah. I think a lot of like the small banks, regional size banks, small banks, they need to lend money to make money. So when you approach a small bank or a regional size bank and you walk in there and you introduce yourself and you say, hey, I'm looking to set myself up for success on this first home build. You're going to meet with, you know, a loan officer or whatever, someone on the loan committee who's going to work with you to try to get you set up to get financing. And a lot of times I think those decisions are made based on if Danny has the qualifications to build a house.
Right.
Well, they need to lend you money to make money, so they want you to be qualified. So they're gonna work with you and try to use everything they can. You know, they're not your enemy, they're your friend. So if you flip 2 houses and if you've, you know, remodeled one, whatever the case may be, you can put together your little package, and your representative at your small bank is going to take that to their round table on their Tuesday morning while they're drinking coffee and say, hey, I got a new client, Danny. He's flipped this house, he's renovated this house, and he remodeled this house. These are his projects, and they're successful. He's a bright guy, smart. He's 40 years old, got a family. You know, they have a conversation at the round table to try to get you approved to then maybe go build. Maybe you're not going to get approved to build $1 million house,
right? But
they may approve you to build your first $200,000 house, and then scale up from there.
Stone. Yeah, it's always a stepping stone. Like any project or any house you buy you're going to learn a lot, and it's always a stepping stone. I've only ever sold one house in my life. I'm 40, and I don't sell them. I buy them and I hold the asset and I let it appreciate. I've thought about, but the only one I sold was the one that had the most equity in, which was my primary home, which I also kind of like did a builder partner thing. I knew the guy. And so I was able to walk away with equity in that house from the beginning. And then we did some upgrades to it, added a pool. Fast forward 4 years, family was ready to move. And so I wanted just to be able to use that equity and step up, right? We talk about step up buyers a lot. Step up buyers are, you know, going to be maybe the guy that's now gotten married, or the girl that's now gotten married, and either one of them own a home, or maybe both of them own a home, and then they want to go buy a house together. So that, you know, step up buyer is what we call that. But yeah, I mean, along the lines of my advice for a first-time buyer or first-time renovator or first-time builder is always start with the first primary home as your first investment. So what can I afford? Live in it for 12 months, 3% down on the first one, live in it for 12 months. At the 12-month mark, buy the second one with 5% down. So you can buy 2 houses basically in 13 months with only 8% down.
Yep.
And you could do a renovation loan on both of them if you wanted to. So that's a really unique thing that I don't think a lot of people understand, because the rules are a first-time home buyer by definition is someone that either hasn't bought a house or hasn't owned a house in 3 years.
Yep.
So technically, if I was divorced and I didn't own a house and I've been renting for 3 years, I'm a first-time home buyer technically.
Yep.
So I could do that with 3%
The name's
down.
so misleading. I don't know why they call it FHA, but
Yeah, FHA, by the way, does not mean first-time home buyer loan.
which is what I'm sure 100% of the population
Everybody
thinks.
does. Yep. FHA is really just a more flexible government product. If you have really good credit and everything, you're probably going to do a conventional loan, and it's only 3% down. FHA is 3.5. Okay, so again, FHA is maybe a little credit qualified, credit challenged. There are some advantages. It's got a little bit more flexible debt to income ratio. So there are really some benefits to FHA, but it's a wider stroke when we talk about like qualification. So, but yeah, I mean, 8% down for 2 houses, and just turn the first one into a rental, and we use departing residents' rental income to help you qualify for this new house. So we're basically able to offset that payment that you already have. So let's say it's a $2,000 payment for the house you just bought. Fast forward 12 months, let's say it rents for $2,300, okay? I can use $2,300 and I can use 75% of that to help you qualify. So it offsets almost the whole payment, and now we're qualifying you on the new house. You know, so that's a hack that I wish everybody knew.
Yeah,
you know,
and it's great advice for people just getting started out.
Exactly.
And but yeah, I think if you're brand new to the community, you're just like, man, I really want to start building, but maybe you don't check all the boxes, but you do have $15,000 to $20,000, and maybe you have a conversation with Danny and you could qualify for like a rehab loan. I think it would be a bomber deal for not only to catapult you profitably to make some money, but also to put a successful construction project on your track record, is maybe to do a rehab job, do a flip. Maybe you buy a $300,000 house, or maybe put $15,000 to $20,000 down, but you buy a $300,000 house, Danny includes an extra $100,000 in the rehab. They appraise it based on the projected value, saying, okay, it's going to be worth $500,000. You go buy that $300,000 house, you put $100,000 in renovations into it. Then once it's all said and done, you sell it for $500,000 or whatever the case may be. I'm not sure all the specifics. Danny can work through you with that. But then you just paid $15,000 as a down payment. You freaking financed the $100,000 in renovations. You profited close to 6 figures. Got your first successful construction project for your track record, that then maybe you can approach a small bank and they will give you a small loan for your first build. So I think that would be a great strategy. It's one that I didn't personally utilize, but I think it's something definitely to consider. If you're brand new to this, you're limited on your income, you have no experience, I think that would be a great route, because obviously flipping a house is going to be a lot easier and faster too than building a house, and you can qualify through that way.
Yeah, I mean, in flipping, I think most people would go hard money on that. That's kind of the typical, you need to go hard money on that.
Okay.
Because banks and lenders, you know, we need someone to hold the loan, you know, well, the secondary market, 3 to 6 months minimum, right? And so, like, if someone comes to me, I'm flipping this house, I'll be out of it in 60 days.
No good.
I don't even have a problem.
Okay, so in that instance, they would need to hold it for how long?
I mean, yeah, I mean, really 6 months is kind of like the ideal
without
scenario.
you getting
like, and it's really just like, what do you want to do with it?
Okay, well, I mean, regardless, if they were to keep it and rent it out or keep it and live in it, you have the project completed, so that still counts as kind of a proven deal for your track record. So I think that would be a great route. So what do you currently see trending in the mortgage market, or what's your take on interest rates? What's your take on maybe the new administration coming in over the past 2 months?
Yeah, the market in general. Yeah, I mean, 23, 24 was probably the most challenging time, certainly in my mortgage career, and frankly, probably for the last 20, because we saw interest rates spike so high in such a short amount of time. And we all got used to seeing 3 and 4%. So I think it's really important to understand why rates were that low. Obviously, a lot of that had to do with COVID. There's one thing that the Fed can do to kind of tip the scales. And so they were buying mortgage-backed securities, which then they stopped. basically. So when that happens, that takes the sledgehammer off the scale, and that's basically why mortgage rates spiked. So we're in more of a free market now. Interest rates are coming down slowly. Interest rates always come down slower than they go up. But we are in a more optimistic point now, and I've seen that to start this year based on the number of people that are now, whether it be pent-up demand or just optimism with where rates are or what the market's doing, or maybe it's just time for someone's life because they got married, because they had kids, whatever the case may be. It's time for them to buy a house. Mm-hmm. And so this first quarter, I've seen personally a lot, I wouldn't say like a lot, it's just the people that I'm talking to are ready. And so there's no, barrier to entry like there was in 22 or 21 rather, where you're competing with 10 other offers. Mm-hmm. Like it's a more balanced market now where you've got, there's actually supply because nobody wanted to sell their 2.8% rate house that had a 2.8% rate. And now either they're selling that because of their life changes or just because they're now ready to buy their first house or whatever the case may be. So there's more optimism now. We've definitely seen, applications tick up, and we also are looking, 8, 10, 12 months down the road that we will see the opportunity to refi. So the cost of waiting for people is something I talk about a lot too. If you don't buy now,
that's a good point.
What is the price of the house going to be? Okay, you don't buy a house because of interest rates.
Yeah.
Our parents didn't buy a house at 10 or 12% rate or 16% rate. That was normal, right? Now prices of houses are different, but when you think about it, what does the house appreciate? It's an average about 4% appreciation per year. So do the math. Yep. You buy now, what is it worth in a year?
Yep.
Okay, another 4% on average across the whole United States. Maybe some market might be only 2.5 this year. Maybe it's 6. Well, a few years ago we saw a 20%, appreciation rate. So that's something that people sometimes don't factor in.
Yep.
And something I would encourage people to think about is like you don't buy a house based on interest rates.
Yeah, all right.
And you can't catch a falling knife like the stock market. Your advisor tell you don't trade a stock and try to time the market.
Yeah, don't speculate.
It's really hard to time mortgage rates.
Or don't listen to anyone who speculates and tells you what the market's going to do because they don't know. No one knows, right?
Right. Yep. There's the investors. What is it, like Unusual Whales and those types of Instagram accounts where they'll follow, different people, like the Nancy Pelosi tracker, right? Mm-hmm. Well, there's one that follows. They do the exact opposite of what the guy on TV, Kramer.
Mm-hmm. Yeah, no, Kramer.
It's the opposite Kramer tracker.
Oh, really?
Yeah, so it's actually an investment fund, or not a fund, but if you want to invest exactly opposite of the guy on CNBC or whatever,
right.
And it actually has a better return than the stock market. Yeah, it's pretty wild. So I wouldn't listen to Kramer.
Yeah.
So
yeah, I'm not big on the people who speculate about the market, but yeah, like Danny said, definitely don't let interest rate right now be what keeps you out of investing into real estate. The price of real estate is going to go up over time, and really it's going to just keep you from keep you from making money now. But my take on interest rate, 6%, 7% is really not that bad. I mean, come on. I
think the happy place, if I was to tell the Fed or tell the whoever that ultimately we're a free market that's based on the bond market. So the bond market is what dictates mortgage rates specifically or directly. So, the 10-year treasury is important to mortgage rates. Inflation is the biggest driver. As inflation is down consistently, right? We're still at 2 or 3% inflation. That's better than where we were, but we really need to have deflation for mortgage rates to be super happy. And if they could get to like 5.5, that'd be a really, really healthy, spot. Yeah. Right now, we're just kind of trying to get that down to 6%.
Yeah, good points. Well, Danny, I appreciate you being on the podcast. I think we provided some very valuable information to real estate investors, home builders, and
Yep.
I really appreciate it. I'm excited to connect you with the Build Club, and there's truly no one else I would rather recommend and using my own business. So I appreciate
Hey, man.
you
Thanks a lot.
doing
I
deals with
appreciate the
me,
opportunity, yeah.
and I look forward to connecting you with the Build Club and y'all getting this
Absolutely.
extremely valuable needle in a haystack connection that I'm providing to you guys. So I appreciate it, Danny.
Absolutely.
Good
Thanks
stuff.
a lot.
All right.